What if you could help stem the tide of climate change? What if you can influence companies to make sustainability a priority? And what if you could do this while still maintaining your intended investment objectives? The RAFI ESG Index series satisfies the dual objectives of sustainability and the potential for outperformance through innovative portfolio construction and through supplementing traditional environmental, social, and governance, or ESG metrics with metrics known to be additive to returns. We use the fundamental index approach, a proven smart beta strategy with a history of outperformance. And on the ESG side, we supplement traditional ESG metrics with financial discipline and diversity. The fundamental index approach is based on the premise that markets aren't efficient and tend to mean revert over time. Traditional cap-weighted indices, which most ESG strategies utilize, have one significant flaw. While cap-weighted indices are low-cost, simple, and transparent, they systematically overweight overvalued securities and underweight undervalued securities, resulting in a performance drag. The fundamental index approach utilizes fundamental measures of company size, like adjusted sales, cash flow, dividends and buybacks, and book value, to act as stable rebalancing anchors and trade against market price movements. This process essentially creates a systematic buy low, sell high investment process, and historically this has resulted in outperformance in developed markets of about 1.5% to 2% per year. On the ESG side, we look at two metrics, financial discipline and diversity. We define financial discipline by looking at metrics like high profitability, conservative investment, low issuance, and low accruals. Companies that are focused on long-term value creation rather than making decisions that benefit management in the short run. Historically, companies with strong financial discipline have outperformed companies with weak financial discipline. Research Affiliates has long been an advocate of cognitive diversity. Cognitive diversity is centered around having a team that has different ways of solving problems because of having different backgrounds and different worldviews. A growing body of literature shows that cognitively diverse firms tend to have better corporate outcomes as it relates to greater innovation and lower probability of governance-related scandals. Now, finding data on cognitive diversity is quite difficult. So for the RAFI ESG Index series, we use gender diversity as a proxy. Our view is that companies with strong gender diversity will tend to have strong diversity in other areas as well. So let's look at our investment process to see how we put this all together. The first step is security selection. We rank all the securities in our starting universe by our 5 individual metrics: environmental, social, governance, financial discipline, and diversity. We remove the bottom 10% of companies by each one of these individual metrics, essentially getting rid of the worst offenders by any one of these 5 categories. Second is that we apply industry exclusions. We exclude companies in the fossil fuel, gambling, tobacco, and weapons industries because of the environmental and societal impact these industries have had. Then we weight the companies. Companies are weighted by a combination of their fundamental weight and their overall ESG score. Companies with high overall ESG ratings will tend to get an upweight to their fundamental weight, and companies with low overall ESG ratings will get a downweight. And the final step in the process is rebalancing. The index is rebalanced on a quarterly basis to reflect changes in company-level ESG ratings. We can look at company-specific examples to illustrate this process. Here we look at Intel, Qualcomm, and Facebook. Intel has a relatively high overall ESG score as it scores well across the 5 categories that we look at. Its overall rating is 0.72, which is the average percentile ranking of any one of the individual scores. Its fundamental weight of 1.2 gets an upweight to about 1.4. Qualcomm, on the other hand, while qualifies for the index, has a lower overall ESG rating, resulting in a downweight from 0.7% to 0.5%. And finally, Facebook fails the social and governance screens and is excluded from the index entirely. The result is an index with a significantly lower carbon footprint and higher overall sustainability ratings relative to the market. The RAFI ESG Index series satisfies the dual objectives of sustainability and the potential for outperformance, and it does so by utilizing the fundamental index approach and supplementing traditional ESG metrics with financial discipline and diversity.